Hi, it's Greg Schnell, and I'm here with your Daily 5. So, the first thing that we're kind of experiencing is a little bit of turbulence in the bond market, and it's one of the reasons that the equity market is having so much trouble. But I think if you don't normally trade bonds or understand the bond market, and I'm by far no bond expert, but from a charting perspective, there's lots going on. And I think the single biggest thing we need to be aware of is just how dramatic the move in the bond market was on Thursday. And I'd like to say it's a blow off top, but we've seen this move over and over and over again. And this just appears to be the next one in the rainbow higher. But what we're talking about was this bond market was at 3% on Thursday after the Fed meeting. And then it exploded all the way up to 32. That's like a 7% move in the 30-year bond yields. Like, that is massive. And we had that all in one day. We ended up only up 5%. But the size of that move, just if we take 0.2%, was the size of the move. In Japan, they're trying to keep their bond market at 0.25. So literally, this would have been almost a double of Japan's yield. And that's the reason that we're getting all of this wild flow in the market. So the U.S. market wants to rage higher, but we have other markets around the world that if interest rates go up at all, they're saddled with debt that they can't pay. So we have this wide dispersion, and it's really causing a lot of damage. So rather than focus on the equity market that is, I'll call it front and center to a lot of our portfolios, I really wanted to cover off some of the background reasons and maybe put it in charting perspective and help people understand where we're at. So to me, this chart still looks like it wants to go higher until we have some sort of a large, longer trend line breaking. The trend is higher. We got a PPO cross to the upside today. It seemed like an exhaustion move, but this would have seemed like an exhaustion move. These three gaps higher would have seemed like an exhaustion move. This has been moving very, very quickly. So my next chart is just to show what's going on. And the Japanese 10-year is sitting here, and they've tried to pin it under 0.25. And Japan was closed today, so that's why this chart says May 2nd. But what you can see is the U.S. market has continued on this week, and it pushed up again relatively fast. But it is now at 3% to close. Actually, the 3% was a couple of days ago. The current closing price for the U.S. 10-year is 3.05. And so here's the yen stuck at this lower level, and this whole acceleration is going on. Why that becomes important, Japan's a G3 country in terms of the G7. It's a really big deal if all of a sudden they start to have debt problems. And so as they try to pin their rate lower, and the U.S. bond market roars higher, Japan is stuck with this upward bias pressure. And so it's causing all kinds of problems in other areas of the market. One area of the market that it's causing is the Japanese yen. And so what we're seeing is as these yields soar on the U.S. market, the junk bond prices are plummeting in the junk bond market and the corporate bond market, and we're seeing those fall radically. Well, look at the Japanese yen. It almost overlaps that. So as these bond markets are exploding, the yen is the currency that's taking the hit to try and make the difference between these bond markets. I don't think it lasts long. You're going to get one or the other, but you're not going to get both stable yen and stable bond. So we're going to see where this ends up exploding, but it's definitely a dynamic situation. And until we have some reason for it to stabilize, this thing could literally blow out. And so one of the problems the stock market's trying to deal with is if that does in fact blow out, we have a really big problem. So we potentially have the Russian default on their debt. Now, again, Russia's been, it was supposed to default relatively soon, around May the 5th, but some of their oil sales have actually been higher than expected. How's that? So anyway, they're still getting some revenue, but the thing is, they're going to be in a bind here. And eventually, you've got a Russian bond market that's a problem, Japanese bond market that's a problem. All of these things are adding up. We still have the Chinese cloud from the Evergrande situation where the property management company was blowing up. So that was another big deal. So in terms of that area of the world, just geographically, the three are almost connected. We have this very harsh situation in terms of debt over in Asia. And the problem is that problem is slowly migrating around the world. So now we have a picture of what's going on in the debt market. Well, what's happening in the US dollar, and this is a really big deal. We're sitting here pinned under the two prior highs. So we closed at 103.80 on Thursday, but 103.82 and 103.96 were the previous closes for the quarter. These are quarterly charts. So this is really looking like it wants to blow out to the high side. But what's more important than anything else on this chart is the very big trend line going back to 1984 that is breaking. And this was the brief COVID bump above it, and then the Fed came in and pulled it back down. So this dollar trend, I'm pretty sure there wasn't a lot of people that had a dollar trend blowing out through 104 or 105 in the second quarter of 2022. If this continues to roar higher, this, between the bond market stress and the currency stress, a lot of the, I'll call it planning for how they're going to move money around and whatever, starts to go out the window, and it's really starting to change on the fly. And the PPO momentum indicator, if it closes where it is by the end of June, so still half the quarter is still to come. This looks like it's ready to explode higher, and this is one of the first times it's ever turned up above zero. All the other times, once it got up there and rolled over, it just rolled straight down. So this is meaningful. And so I posted, whoops, I forgot to change the header up here. What I did was I posted all of the currencies, the euro, the Canadian dollar, the British pound, and the Chinese yuan. And you can see that 3 out of 4 of these are really collapsing. The Canadian dollar is okay, but it looks like it's very risky here too. And normally it would follow the price of crude, or it would lead the price of crude. The big question I have is, why is it not? And so even back last year, crude was going up and the Canadian dollar wasn't. But all of a sudden, this looks like it wants to break lower, and all 3 of the others, British pound, the yen, and the Chinese yuan, are all starting to bail. So we're in this situation where there's immense pressure for the US dollar to go higher, immense pressure for US yields to go higher, and yet the rest of the world is having problems dealing with this. And Canada would have a problem dealing with a lot of changes in their debt interest rate. Japan has debt to GDP of 260%, so they would really have a problem. And again, the move in the US interest rate today was, or on Thursday, was almost a double of what Japan's been trying to hold their interest rate at. So there's immense pressure coming here, and either the currency bails or the yen's or the bond market cracks. Something's going to happen here. So don't want to be a doomsayer, but all of that is adding big pressure to us as investors, and that is one of the reasons we can't seem to get out of the way of the market here. And if you're interested in the work we do at Osprey Strategic, one of the big things I think that we offer is a unique way of investing where we try to preserve our capital, step into the market when it's favorable, preserve our capital, step in when it's favorable, and just trying to keep staying on the positive side of the market, and just stepping out, going playing golf, spending time with family and friends when the market is in a downtrend. It's not quite that easy, but that's what we try to help with. Currently, our index is very low at 6% and declining. So It's basically suggesting we're ready to turn higher, but we tried and we failed so far. So anyway, it's only $860 for a membership at ospreystrategic.org, and you can find that on the homepage. Feel free to go there. We have lots of insights for you, and hopefully take a trial if you're interested. Thanks, everybody. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.